The prospects of economic cooperation and integration in Africa lies on key issues like Pan-African financial services. At the moment, there are several challenges facing Pan-African banking. This was recently highlighted by the former Group Managing Director of the United Bank for Africa, Mr. Phillips Oduoza, at the 4th valedictory lecture of the Chartered Institute of Bankers for Nigeria.
Though improving significantly, the political climate of some countries in Africa is still volatile and governance is unstable, thereby exposing the bank to political risks. In Africa, there are few truly democratic regimes, with most under various forms of undemocratic regimes in line with global definitions. Such regimes threaten the ease of doing business. Actually, according to the United Nations, just 14 out of the 54 African countries recognized by United Nations practice a globally accepted form of democracy, while others engage in less desirable governance, ranging from authoritarian to transient governments due to conflicts. Such governance situations pose most visible threats to suitable and viable business environments. The second big issue that is a major challenge, and it is peculiar to virtually all the African countries, is the infrastructure gaps that we have. Infrastructure deficits on the continent represents another major challenge for the bank. Infrastructure such as power, transportation, telecommunication are often inadequate and of relatively poor quality where available. As such, the cost of operation in countries with poor infrastructure is much higher than others with relatively better infrastructure. UBA has experienced some instances where we actually have to move ATMs, the automated teller machines, from one country to the other because of poor supporting infrastructure. The third challenge is policy inconsistency. Similar to Nigeria, we have encountered frequent changes in policies which often occur as the government and regulators of operating host countries try to grapple with their economic challenges. Resource commitment by banks to comply with new regulatory policies are not optimized due to frequent reversals of these policies. This makes doing business to be unduly cost prohibitive. We have also seen, where regulatory agencies have not acted in the interest of businesses coming from other countries. A typical example is in some countries where increase in capital of the banks is called for. The foreign banks are treated differently from the domestic banks. We saw the case in Ghana when there was increase in the level of capitalization, and the foreign banks were given a very short deadline to comply, whereas the domestic banks were given a longer period to comply. The African market remains highly fragmented as tariffs, permits, and licenses, as well as other regulatory barriers, increase transaction costs and limit the movement of goods, services, and people and capital. If you stand between Nigeria and Benin Republic, is the border called semi-border. You will see goods moving, in both directions, from Nigeria entering into Cotonou, and then from Benin coming into Nigeria. And the size of that economy is very, very massive. It is bigger than economies of some African countries, just within that region alone. And we think that the central banks and regulators will probably need to collaborate just to promote this through trade platforms and encourage the informal trade to enter the banking system. We also have the issue of payment, challenges, the payment infrastructure. We have in Nigeria where a transaction from a UBA can be executed in a Diamond Bank. For instance, if you are carrying a UBA card and you go to a Diamond Bank and vice versa, you will be able to do your transactions. We have some countries that do not have a switch. They are not integrated. And as such, if you have your ATM card, you can only do transactions in your own ATM, in your own bank's ATM only. You can't do it in another bank's ATM. That is a very, very big constraint. The challenge of operating in a mono-commodity economy, as is the case for some African economies, lies in the over-reliance of the economy on one commodity, exposing it to headwinds from fluctuations in commodity prices with attendant pressures on the country's currency, thereby affecting the economy's health and performance. And we have a situation in Zambia where the economy, just like Nigeria, is dependent on oil, depends essentially on copper. And copper forms probably about 77% of the exports. In 2015, within a space of a 12-month period, the price per pound of copper fell by 24% to $2.13. As a result, the Zambian kwacha depreciated by 71%. It is the same story that has been playing out in Nigeria of late, where the economy is at the verge of a recession due to over-reliance on oil that has experienced a price drop of about 70% within the last 18 months. The solution, therefore, lies in the adoption of a diversified economic model by the government in order to ward off these incidences of mono-commodity-driven macroeconomic headwinds.
With the realities of the diverse issues encompassing Pan-African banking today, a structural, policy-driven, but most importantly, coordinated efforts amongst African nations could shape the future of financial services in the continent.